Okay, so in this video, we're going to set you up so that you can quickly learn the 2 easy steps to setting up an Iron Condor, one of the most powerful options trading strategies used by professional options traders. So forget about people who've tried to convince you that options trading is complicated. There's only 2 steps you need to learn to execute an Iron Condor using just about any online broker. And what's more, the amazing thing about Iron Condors is that you are in the driver's seat to determine how likely it is that you win the trade. Not the market, not the big institutions, you. You're in complete control of the probability that you'll make money on this trade. And while that may be hard to believe, I assure you that it's true, and we'll get into that shortly. What I want to show you now is an options chain of SPY, and these options have 7 days until they expire. SPY is trading at 653.02, and on the top half of this chain are what are called out-of-the-money calls, which are basically any call option located above the trading price of SPY, so 654, 655, etc. They all have strike prices above where SPY is trading. And on the bottom of the chain are the out-of-the-money puts, and those are all the ones located below SPY's price, so 652, 651, 650, and so on. And so we know that if these options remain out of the money, they will gradually go to zero. And so I'm going to show you an example. So let's just reference the 666 call strike, which is 13 points out of the money above where the stock is trading, and its price is $1.83. And focusing on the put side now, that's 640 put, which is located 13 points below where SPY is trading, and therefore is out of the money also. That's going for 317. Okay, now let's fast forward to 5 minutes before these options expire 7 days later, and you can see that they are much cheaper. And if you look at the 666 strike call option, well, SPY's about 2 points below that strike price, so that option is going to expire with no value, and so no wonder it's trading for less than 2 cents. And that 640 strike put that expires in 5 minutes, well, that one's way below SPY's price, and so it's only worth 1 cent. And that makes sense, right? Because if the market only has 5 minutes to go, the right to buy a stock trading below where the market is trading is obviously going to be close to worthless. And so naturally, that call has almost no value, and that put is way below where SPY is going to close. So it's basically completely worthless because the right to sell your shares at a price way below where the market is trading is obviously of no value. And so if you think about it, what this means is that each and every day, the options premiums of every option, what are known as the time premium of those options, is sucked out of these options. Now, if you buy options, you already know that. In fact, you are constantly fighting this time decay. So instead of fighting it, we prefer to let it work for us and have that very decay make us make money. And so you might be wondering, how the hell can you make money on an option where the value is getting sucked out of it every single day? Well, we're going to show you exactly how that is accomplished. And so let me show you one of our favorite option strategies that you can start utilizing immediately to put the natural time decay of options in your favor, even if you only have a small account. And we can achieve this by trading an option strategy known as the Iron Condor. So what exactly is an Iron Condor? Well, don't let the name intimidate you. It's actually simple. It's really executed in 2 easy steps. The first step in building an Iron Condor consists of selling an out-of-the-money call well above where the stock is trading and simultaneously selling an out-of-the-money put well below where the stock is trading. And we would do this in hopes that between now and expiration, the stock will stay in between the options we sold, in which case they will both go to zero. And if that is in fact what actually happens, we will keep all the cash we sold these options for. But since selling options can have a lot of risk and can require a lot of capital, we are also in the second step, going to buy a further out of the money put and call for protection. And so these 4 options trades are collectively called an Iron Condor. So again, we're selling 2 options, an out of the money call and an out of the money put, and buying 2 options, further out calls and puts surrounding those options we sold. So how does this work? Well, let me show you using that same example we just talked about with SPY, which you'll remember was trading at 653.02 per share at the close on October 10th when we started the trade. So pulling up an options chain, which expires a week later on October 17th, let's sell 10 of the 666 calls for $1.83, 13 points above where SPY is trading, and we're also going to sell 10 of the 640 puts for $3.17, 13 points below where SPY is trading. And our premise is that the stock will stay in between these strikes and the options we sold will expire worthless. But again, since naked options theoretically have an unlimited risk, we are going to buy some protection. So we're also going to buy 10 of the 668 calls for $1.34 and 10 of the 638 puts for $2.81. And I know that keeping track of all these individual options trades seems like a lot to keep up with, but we can actually trade an Iron Condor with one single order. All options brokers will give you a menu of option strategies to choose, and all you need to do is choose the Iron Condor option and then just fill in the strike prices you want to use. Okay, so now we initiated this trade with 7 days to expiration. And as time passes and we near expiration, let's say the stock doesn't move much and just kind of bounces around in a small range. So on October 17th, the day these options expire, SPY did in fact close at 664.39 inside that range, because 664.39 is both below the short call up at 666 and the long call up at 668 and above the short put down at 640 and the long put at 638. In other words, SPY closed between all 4 options. Below the calls, which only have value if the stock closes above those call options, and above the puts, which only have value if the stock closes below those options. In other words, all 4 options expired worthless. Well, if all these options are worthless, what does that mean for our trade? Well, let's take a look at that. You see, when we first executed the trade, we sold those 666 calls for $1.83. But remember, a call option represents the right to buy 100 shares of stock. So we multiply that by 100, and we sold 10 of them. And so we collected in full $1,830. And with the same math, we received $3,170 for those 10 puts at 640. And remember, we bought that protection, and so those cost us $1,350 and $28.10 for the calls and puts that we bought, respectively. And so netting it all down, we ended up collecting $840 if you think about it. So I want you to think about it. If that's the case, that all 4 options expired worthless, then guess what? And this is the key to the whole thing. We get to keep the initial $840 that we collected when we first sold the Iron Condor in the first place. That upfront cash is ours to keep. In other words, that's our trade profit. So by trading an Iron Condor, we are simply betting that the stock will stay within a certain range. And we treat it as one trade, even though if you think about it, we lost money actually on the long calls and puts that we bought because they expired worthless and we paid for them. And they turned to zero. But that's exactly what we want to happen, believe it or not, because we simply bought these options as protection. It's kind of like you pay for car insurance, but you don't actually want to crash your car. But we made so much money from selling those calls and puts that were closer to the money because they ended up being worthless also, even though, by the way, there was a buyer on the other side who bought those calls and puts from us. But in any event, the ones that we sold, well, they went to zero. So we just pocketed what we sold them for. Okay, so now that you know how we make money on the trade, let me show you how we can lose money. Every trading style has losing and winning trades. And also, what is the most that we can possibly lose on Iron Condor? So let's say that instead of SPY moving mildly, like it did in that last trade, what if SPY goes just crazy? And although it is completely unexpected, it goes well outside of that range between the short calls and the short puts, the range where we wanted it to stay in. And it doesn't do that at all, but instead it ends up at $695 per share on the day the Iron Condors expired. Well, we already know that both the long put and the short put would close out of the money and are worthless so far below, where SPY closed. So those are going to go out worthless. But what about the calls? Well, the 666 call is now 29 points in the money. So it's worth 29 because that's the right to buy the shares for $29 less than they're worth. And by the same token, the 668 protective calls that we own, that we bought, those are worth 27. And so pulling all four legs together, let's see how this comes out. Starting with the initial cash flow we received when closing the trade, we would have to pay $29 to close out our 666 calls, so that will cost us $29,000. But then we'll receive $27,000 for selling the protective calls at 668, and good thing that we bought those because of what happened. And of course, both puts expire worthless, and so adding up all of these numbers totals to a net loss of $1,160 on the entire trade. But here's the cool part. We lost $1,160 on the entire trade, but that's the maximum amount that we could have lost on the trade, no matter how high SPY rallies. It doesn't matter if SPY went to 700 or 1,000 or infinity for that matter. Whatever the case may be, we can't lose more than $1,160 on this trade. And the way we end up with this maximum loss situation is if the stock goes beyond our long option strikes on expiration day. And that's because no matter how far SPY had run, once it gets past that long option, the loss we are taking on the short options is always going to be offset dollar for dollar by that long option, if you think about it. And that's why we buy the protective call in the first place, to put a total cap on the amount that you can lose on the trade. And in fact, the maximum amount you can lose on this trade is exactly how much capital you need in your account to trade the Iron Condor, because your broker always wants to make sure that you have enough in your account to take on the full risk that you're trading. And so even if SPY went to 800 or something crazy like that, you still would have a maximum loss of $1,160, as you can see from this example, where the short calls blew up to 134,000, but the long calls blew up to 132,000. And so that trade loss is exactly the same, $1,160, no matter how SPY goes, no matter how high SPY goes. The call values will always be $2,000 apart. And so now you know that an Iron Condor loss will always be limited to the difference between the value of the short and long options minus the original premium that you received for selling the Condor in the first place. And so that is the reason that Iron Condors are so powerful, because we can sell options premium protected by cheaper long options, which means there is very limited risk and a corresponding small amount of capital needed. Now, we've been talking about how we can make money or lose money on an Iron Condor, but you might be wondering when exactly we would break even on an Iron Condor. You saw how if the stock closes between the calls and the puts, you get to keep the entire initial cash flow that you received. And you saw that if the stock blew way past one or the other sides of the Iron Condor, either way above the calls or way below the puts, then we'd lose the maximum we can lose on an Iron Condor. But what if the stock ended up between the short call and the long call, or between the short put and the long put? Will we make money or lose money? Well, it actually depends. Let's take the same example that we were just looking at, but this time SPY closes at 666.50 on the day the options expire. Well, this time the 666 call does close with some value, 50 cents, as you can see, because the value of the right to buy the stock at 666 when it's trading at 666.50 is obviously 50 cents per share. So that means to buy it back to close that position would cost us $500, as you can see from the calculation. But then the call above it at 668 actually closes out of the money and expires as worthless as the two puts do. So in that case, we still have some change from that original $840, yielding us a smaller but still profitable $340. And as you've probably figured out by now, you'd make money at any price above 666 as long as it doesn't get past 666.84. Because at 666.84, the amount you'd have to pay to close the trade exactly equals the amount of cash you received in the first place. And so 668.84 is the break-even price on this Iron Condor. And so for every Iron Condor, you'll make money at any price as long as the payout on the short options are less than the original cash you got in. And so the profit range of an Iron Condor is actually a little bit past the short call or the short put location. So the trade is even a little more powerful than you might have thought. And finally, as I mentioned in the beginning of the video, the amazing thing about Iron Condors is that you are in complete control as to the probability of your making a profit on your Iron Condor. And why do I say that? Well, let's take a look again at the SPY trade. But this time, I want you to focus on something else on the options chain. You see that column called deltas? Well, that is a reference to how much the options price is likely to change if the stock price changes. But, and here's the incredible part, it also has been shown to have a correlation to the probability that an option will expire with any value on expiration day. In other words, the chances of it expiring in the money on expiration day. And the call delta is 21.24, as you can see, and the put delta is 25.14. And so the way you figure out an Iron Condor's probability of profit is by subtracting the short call delta and the short put delta from 100. So for example, the probability that this Iron Condor will make its full profit when it expires is 100 minus 21.24, the short call delta, minus 25.14, the short put delta, which comes out to 53.61%. And so you could choose that, but suppose you wanted a much better chance of making money on the trade. Well, all you do is widen the Iron Condor to lower deltas, which means higher probability. For instance, if we move the short calls from 666 to 670, which is the 1330 delta calls, and we move the 640 puts all the way down to the 626 short puts, where the deltas are 11.67, then let's take a look at the probability of this trade working out. And as you can see, it's way better with a little more than a 75% probability of profit. And that makes intuitive sense, right? Because the farther you push those short options out, the more likely they are to expire worthless, because the stock has a wider range to run around in, and therefore a larger number of instances where it will close between the calls and the puts. But you all must intuitively be thinking, hey, wait a second, why not set up every trade with such a high probability of profit? Or even push the deltas out further and make it, say, a 90% probability of profit, or even higher. And it's absolutely possible to do that, to just keep pushing the shorts out farther from the current price. And in fact, you'll notice that the deltas just keep going down the farther you push those shorts out. But there's a catch. And the catch is that you'll be making less money per winning trade, and you'll have to use more capital. For instance, in this example, as you can see from the calculation, all the options are cheaper, which makes sense, right? Because the farther they are from the current price, the less likely they are to end up at that far away price 7 days later. And because they're so much cheaper, the net amount of positive cash flow is way less, only $430 this time, when the previous example yielded you $840 of cash flow, almost twice as much. Yet you needed more capital this time, $1,570, which is far more than you needed in the previous case. And so that's the trade-off. If you want a more probable winner, you're going to have to put up more capital and actually take some more risk and accept less reward. But it's going to be more probable. So that's a personal choice that the trader has complete control over. And so what I'd like you to take away from today's video is that Iron Condors are an incredible trade to have in your trading arsenal. What other trade can you think of where you don't have to predict direction at all? The stock can move up and down all at once as long as it stays between the short calls above and the short puts below. And you can make that range as wide as you want, increasing your probabilities to a very high level if you wish. Although you'll need more capital and you'll be making less money if you do push those short options out very far. But there are cases where that might be a good idea, particularly if the market's very volatile. And so if you'd like to start trading a high probability strategy with a wide range of profitable outcomes, the Iron Condor option strategy may be a strategy you're going to want to employ.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window. So don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.